Welcome back to Market Call. We're talking about North American large caps, and with that in mind, we're going to the Twitterverse where Al in Scarborough has a question on Campbell Soup Company. It seems like these food stocks are very hot right now. Campbell Soup close to an all-time high. Do you still like it here?
So there's two key themes in the market. One is people who are betting on low interest rates, low inflation, low growth. And in that camp, investors are choosing to say, I'll buy a dividend payer as opposed to fixed income at record low yields because I will get a little earnings growth. Campbell Soup's not an exciting company, but it's a pretty defensible company. And so the reason people are buying this company is it pays a 2% dividend that will slowly grow over time. So it's not economically sensitive. And the thing that's important to know is in the bull market of the 1950s and 60s, against 2% interest rates, people chose to buy dividend stocks, and that led to a craze called the Nifty 50, where people were paying 60 to 70 times earnings for these dividend stocks. So when people say consumer staples companies are very expensive at 21 or 22 times earnings, that's against recent history. If you believe that we're in a low growth environment for a long time, these consumer staples and utilities and telcos could trade at significantly higher multiples because simply for a shareholder, it's more attractive than what you get in fixed income almost anywhere in the world.
And this was actually a video question. I'm sorry. I thought it was just from the Twitterverse. So, Al, that's how you got to the front of the line. But I want to pick up on something you just said about dividend growth. When you're looking for income, how closely should you be focused on the dividend growth rather than just the yield you're getting off the bat?
It depends on your view. If your view is that we are in a low growth, slow growth environment structurally for a long time, then things like utilities and telcos with almost no dividend growth, would be something that would be attractive relative to bonds. If you think that we could get reflation, which is what the central banks are trying to do, and rates could rise and the economy could get a little better, then you want to focus on things with dividend growth, which are going to help you offset the impact of rising interest rates. Frankly, both camps are working right now, and it will become clearer as we go forward whether in fact we can get a pickup in growth or whether we wind up with a structurally low growth environment.
Let's go to the phone lines. Alex in Toronto, go ahead. What's your question?
Hello. My question is on U.S. banks, in particular Bank of America, currently trading at around $14.20 or something like that. I'm just wondering if you would be a buyer of Bank of America at these levels, or would you prefer another American bank, or even a Canadian bank for that matter? I know the TD Bank is heavily into the U.S. as well, so that's almost like an American bank now. So I would like your opinion on Bank of America, and would you be a buyer? Thank you very much.
Great. So when you look at the U.S. banks, it's really important to consider where we've come from. Certainly the big banks were constrained over the last few years as the Fed made it clear they didn't want them returning cash to shareholders until they built up fortress balance sheets. And as a result, people held off on investing. They've all been given a clean bill of health at this point. Now, Bank of America gives you almost a straight shot at the U.S. domestic economy. 85% of the revenues come from domestic economy. The banks in general lagged the market until a few weeks ago when the Fed came with that decision. So they retested their lows of February. Now the group is starting to lift. Bank of America is a great way to get exposure to the domestic economy. I might also, though, consider something like JP Morgan, which has very strong capital markets business. Both, I think, are very attractive. Both, I think, you'll get great dividend growth. Bank of America just hiked their dividend. They're going to buy back a lot of shares. You'll see additional dividend hikes, I think, going forward. It's hard to imagine the market rallies without the financials on board.
What about what he said about TD that's basically an American bank? And we hear so much from portfolio managers, I like TD because of its U.S. exposures, but it's not really an American bank. Most of its business, right. 60% of it, is still Canadian.
That's right. And I have to say that, look, I think that much like the 1990s, Canada's economy is likely to be less robust and improve less than the U.S. economy. U.S. economy has restructured their housing market. They've restructured their financials. They've come through a very difficult time. Canada may be facing more difficulty going forward. I think that it's likely that energy prices could remain close to the cost of production for some time, which makes it less attractive maybe at the margin than the U.S. economy. So I'd prefer to focus on a pure U.S. bank, although TD Bank's a great bank, and if you had to have one in Canada, it would be a good one to own.
Natalie in Toronto, go ahead. You're on the line. What's your question?
For taking my call, Mr. Burrows, I value your opinion very much. I've been holding AT&T and BCE for many years, and I've seen that they've gone up really very much in the last few months. I love the dividend, but I just want to have your opinion. Should I continue to hold or should I get out because they've gone so high?
Right.
Thank you very much.
So Natalie, you are in the middle of one of the key themes in this market, and telcos have been performing very well. Both AT&T and BCE have been good choices. BCE behaving better than TELUS over the last year or so. And so long as we are in a lower rate environment, these should continue to perform well. But as I said earlier, right now both cyclicals and non-cyclicals, economically sensitive and not economically sensitive, are doing well. I think that over the next year it will become clearer which path we're going to take, the 1950s or the 1980s, 90s. And if it should be that the economy starts to pick up, these will less probably underperform the market, but that's not clear at this point. So I think that they're both good. I'd continue to hold them. There's a lot of people who have fixed income who need a greater source of return, and they will not sell their bonds and go and buy Google and Tesla. They're most likely to buy this type of thing. So I think you do just fine.
And of course, just a reminder, BNN division of Bell Media, owned by BCE. Quick break now. We'll be back with more from David Burrows. We're talking North American large caps, so give us a call.